All right.
Let
You
me,
can grab it back now.
okay. And yesterday we started to cover this particular screener, which is looking at a strategy, a time spread or a calendar spread. And this focuses on the calls. So the call options, you could have a calendar spread with puts, you could have a calendar spread with calls. So we started looking at the calendar spread with calls, and we we discussed these different data elements on the option screener. And besides this one view, you do have these tabs that give you additional analytics that are related to the stock or um, the strategy itself. Okay. Um, so let's maybe go over some of these. We have this summary, and then we have these events. And the events themselves are important because when you trade options, um, some of those events are important to the pricing of the option or the volatility of the stock. Um, and if we detect an event that you know that's out there in a press release or wherever we pick it up, we will add it onto this page. And as you can see here, the next dividend in Apple's November 8th. That's when we're expecting it. The next earnings is October 31st. And let me see if there's, so these two are important because you want to know if any of these expirations will cover the event. So November 8th in this Apple, here's this, the spread is November 15th and December 20th. So the December 20th, you would be long. The the nearer term, November 15th, you would be short in this particular strategy that we're analyzing. Since November 8th comes before both expirations, you have to be aware that there's a dividend that is expected. And why is that important? Well, first of all, both options are um, we'll have to include that in the cost of carry. And there is a potential for an early exercise, early assignment because of the dividend, right? So when stocks have paid dividends, and if you are trading an option that's that American style, right? You have a European American style, you have early exercise, which means you could exercise that option and convert it to stock before expiration. Okay, so because of that, when a dividend is about to go X, then depending where the option is and the stock is, right, that option might become a candidate for an early exercise. Uh, the option you're long, you'd have to decide if it's more economical and advantageous to exercise your call, convert it to stock so you could collect the dividend. Obviously you have to know what you're doing, so, when you're exercising that call, but it could be more advantageous to exercise a call before expiration to collect the dividend because the option holder won't get the dividend. At the same time, you're short an option. So if you're short an option, and like in this situation, then you could get assigned because the counterparty can decide it's advantageous to exercise his right to convert that option to stock. And if that counterparty does it and you're on the other side of that, well, you went from being short an option to the next day being short stock. Okay. So dividends are an important event in option pricing and in uh, strategies and option strategies. Of course, the next one is an important event because you have earnings. So earnings, knowing the next earnings date is important because you could have both options that cover the earnings. So you have to take that into consideration, the potential volatility. You could have one option that covers earnings, one that doesn't, right? Like the near term option may not cover the earnings. It might expire prior to earnings. And then you have the option that's further out, still has days to expiration that may cover it. Or maybe both options don't cover the earnings because they both expire prior to the next earnings. But it's important to know those things to be able to more appropriately price and evaluate that strategy. All right, so these are the known events. And if we come here in a summary, actually, if there is an event that we detect within that expiration, so here's your the summary page, and here are the legs, right? When you're doing a time spread, you have the same strike. So it's opposite of vertical spread where you have same expiration, different strikes. And then time spread, you have same strike, different expirations. So here's the strike, and then you have the two expirations. If we, for convenience, if we detect something, an event that will happen prior to that expiration, we'll put a little indicator like an E that stands for earnings. So you see that E, when I hover over, it tells us, oh, next earnings is October 31st. So that kind of just quickly, if you're eyeballing it. Now I'm going to slide down here, and do you see where it says EC? So E, this is in Microsoft. So the E is telling us there's an earnings, like we just discussed. If we hover over October 30th after the market close, so obviously that's on both expirations, November 15th and December 20th. But there's a C there. So the C is letting us know that the company indicated that there's going to be another event that's not earnings, but it may be worth considering because it may or may not be substantial, right? We don't know what the event will bring. Sometimes it's nothing. Sometimes it's, just there's an event, they talk about it and they say things that they've said before. But they may have a industry conference or investor relations or something that they may reveal something new, like a new product or updates on something that they haven't before, or maybe a guidance. Something could happen whenever management is talking, all right, or people are asking questions. That may be significant and create more volatility. So when you see that C, we detected some kind of a company event. And when I'm hovering over it here, it's saying that on December 20th, that they're expecting to have their annual shareholder meeting. Okay, so the company said that. So now on the December 20th expiration, there are two events there, the earnings and an annual shareholder meeting. One's coming up October 30th, one's coming up December 20th. So that's an important piece of information, especially if you're considering, well, I'm going to be long that option. Well, there are two events there that could potentially move the stock and impact the volatility and implied volatility of the option. Okay. Now, of course, if you're short, you need to also consider that if you priced it to compensate for that uncertainty. So that's the events in summary. The market data here gives us a little bit more information about these options. So for example, here, when we look at I'm going to come back for a second to the summary. Sorry for keep doing this, but in the summary, you could see that we're evaluating the price of this calendar spread based on the displayed offer of that spread. So if you bought the ask price on December 20th and sold on the bid price on November 15th, that's the displayed price that you could, that it's saying you could execute it on, right? But of course, that's just one reference price that we start evaluating it. And if we look at the market data here, we could get more information here. So this is the price, 261. But we could see that the spread is bid 247, offered at 261. Okay, so that is something to consider, because if you're placing your order for execution, if you're buying something, you're trying to get the lowest possible price, right? The lower the price you could buy, the better it is, because you have less risk and potentially more reward, right? If you're selling something, you're trying to sell it at the highest price. So given that here's the market, 247, 261, there's some room away from the offer to get a better price. 260, 259, 258, all the way down, right? All the way down to, anywhere above the bid. So that's something to consider as well, especially, if you're looking at the liquidity of the markets, how tight the markets are, and if you're still considering it, how much room there is to improve your execution beyond the offer. All right, so that's the bid ask of the spread. And then you have the individual options. So this is November 15th, the market's 279, 283. And you have the December 20th, the market's 530, 540. And this is the delta of the option. One is 30, one is 38. Okay, so that's the part of the market data. Let's just do the next tab. Just go over the tabs here, just before we could go to the analysis, just to understand the data available to us. And when we look at these technicals, it shows, yeah.
We just had Chris who initially asked the question a couple days ago concerning calendar spreads. He's asking a question, and I don't know if he's putting it out to the group or you, but I figured I'd read it and he could get back. He says, and if there is a benefit in selling higher IV versus lower IV, do we want to see the short front month that is more than, say, double or more purchased further out option, or does it matter?
So I think the question is,
oh, I see. Oh, I'm sorry, that was Rob.
Yeah. Was there a follow-up on that?
No, I guess maybe Rob is, I missed Rob's piece. There's so many things flying by, but Rob says currently there is a bull put spread showing on, now the bull put spread, I'm assuming we're talking about calendar spread, so it's a different thing. Anyways, I'll get that question later to you. That's not important. But his is the benefit of selling higher IV versus lower IV, I think, in the front month, say, versus the outer month option. Does it matter?
Okay. Well, the next tab's volatility. We'll just cover it there. Okay.
All right, perfect. Sorry about that.
Yeah. So then quickly, before I get to that volatility question, we have this one tab here with technicals. And this is just really quickly to try to get a sense of, on a technical basis, like what the stock is doing, right? Now, there's like a million ways to look at a stock from a technical point of view, but this is just kind of quickly referencing the technicals that we created just to get an idea, well, what's the stock been doing, lately? So this uptrend, and if you hover over it, it'll kind of explain it to you and saying that Apple has been moving in an uptrend, meaning that the stock itself is moving in a fashion that the moving averages are all, the shorter term are above the longer term, right? So that when we look at how is the stock moving, right? Well, if you have the stock above the 20-day moving average, 20-day above the 50-day, 50-day above the 250-day, when you're seeing that type of comparison, then we're saying, okay, it's just kind of moving in an uptrend. It's looking instead of looking at a chart, we kind of just give it that type of an indicator. So that's what it's been doing, based on its moving averages. What about on the day? So on the day, sometimes you just want to know, okay, how's it been doing today? Just on the most recent day. So this is just referencing, well, if we created a support and resistance band, based on the volatility of the stocks, daily volatility of the stock. Okay, so we're like, okay, the stock started here. If we look at the volatility band of the stock and give it a 1 standard deviation, all right, is it within up or down 1 standard deviation, or did it trade outside of that band in either direction, up or down? So that's what it's just to give us a quick reference what it's doing. Plus, it makes it easier to filter these things, right? Not only see it, but if we wanted to filter for that specific situation. So this, when it says below the support, yesterday, Apple, down 2.2%. You can see in the video, a lot of them were trading below its daily, volatility band that we were calculating for this stock. So that's what it is. So it's just giving you like a sense of what's going on, right? So if you're looking for stocks maybe that potentially are breaking out and above their band, you could filter for that. You're looking for stocks maybe breaking down and they're below their trading below their volatility band, then because it's implying like some kind of price action is going on, right? That to push it outside. Then we got a couple more indicators here is how far it is away from its 52-week low price and how far it is away from its 52-week high price. So the idea there is that, we're looking at where the stock is priced currently versus 1-year range, right? Is it close to its 52-week high? Is it close to its 52-week low? Is it somewhere in between? So it's giving us a sense of like where the stock is from that perspective. And then this looks at the option order flow that we're calculating based on our methodology. We're making these interpretations, how the order flow is moving in the stock, and then converting that volume into net delta volume, right? So a negative net delta would be more negative order flow, negative delta. Positive delta is more positive order flow, more bullish order flow. So that's just trying to get a sense of how the options are trading and if there's a particular large imbalance. Now, keep in mind, when things are trading, there's always going to be some kind of positive or negative. It's not going to always be zero. So when we look at this, it's also important to then go in history and see if this is even within a range, negative 600,000 deltas in something like Apple is probably not that much, because what is 600,000? Like we could look at it with Apple's $230 stock. So negative 600,000 deltas is 3,000 shares, right? That's 3,000 shares equivalent to, which is nothing in Apple. It trades probably, I don't know, tens of millions, maybe 100 million. So you know, in that perspective, it's not, these are not very high numbers, but those are just the numbers that we're tracking and, you know, and aggregating as the day goes on. Okay. So that's with the technical part. The volatility is looking at these options and saying, okay, what are the implied volatilities of the options, the related implied vols, right? So some, because we were doing a horizontal spread, we have different expirations, so they could have different implied volatilities. So, you know, one implied volatility, here's one. There's a near option, right? So the near option, we have the bid and the offer, because you have a bid and an offer, so you have two implied volatilities, and then you have the further away option, which you have the implied volatilities for the bid and the offer. Okay, and we could quickly kind of compare this to the historical volatility of the stock 20 days and the historical volatility of the stock 1 year. So the question is like, well, is it better to, when you have a high implied volatility in the near term versus a lower volatility in the far term? And you have to understand the dynamics of the options. That doesn't mean that necessarily the near term is priced higher than the longer term. It's not like an arbitrage where you're doing this, right? Because near term options are much less sensitive to a implied volatility move than a further term, the further you go out. Okay, because it has more time premium. So because of that, because you have a lot more time premium in longer term options, they're more sensitive to an implied volatility move than a nearer term. Like sometimes just to make it equivalent, right? If you have an option that expires in 2 days and one expires in 3 months or 1 year, well, one implied volatility move in a further term option could be, I don't know, I'm just making this up, could be equivalent to $1, right? The option could go from $10 to $9, maybe, you know. But in a near term option, one implied volatility move could be 2 cents, right? The option could move from, you know, 50, whatever it is, 10 cents to 8 cents. So you can't just look at the implied volatility, even if there's a big discrepancy. Let's just say, and you're going to see this a lot during earnings. That's all, you know, during earnings, the near term option implied volatility will be higher than the further term, right? It's it's not unusual. That's what happens when there's an expectation of extra volatility in the short term. And so when we look at that, you have to, that alone is not enough criteria. You could filter that out and maybe look at, you know, potentially if there's a very large skew, you could analyze it, and depends on the volatility you're expecting in the near term. But that would not be enough criteria to say this is higher than this, so I should, you know, so I should buy this and sell this, because obviously that would be, you could program to do that, right? And anybody could just program to look for that situation and trade on that. But that doesn't necessarily mean that the markets are inefficient or mispriced. Okay, that's indicating that the near term options are higher because there's an expectation of volatility, you know, potentially even a gap in the stop, and that's what's being priced in. Right. Hopefully I think that's what the question was, and that's what I'm trying to answer. And we'll go over some examples if you want to see them. You know, we'll go over some examples on earnings, because
Yeah, let's do some examples tomorrow. We actually had a question from Rob about, now it's not a calendar spread, about bull put credit spread he was asking about with Amazon earnings coming up. But some examples would be awesome. Maybe we can start doing that tomorrow. Awesome job as always, D. Everyone have a great day. Stay safe out there. Thanks, buddy.
Thanks, everyone. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Awesome job, D. Actually, Chris just chimed in. He asked the initial question days ago. He says, yes, that was the question. It was perfect. Thank you.
Yep. All right.
Awesome, D.